Well, the market's begun 2012 with strength and resolve, and it's this the question now, I guess, for everyone is this tone right now we're seeing so far this week going to be the tone for the entire year? Well, my first guest says it really all rests on earnings. Joining me now is Keith Springer, president of Springer Financial Advisors. Keith, are you excited at all by what you're seeing the first few days? This is what I'm excited about. We had a big day the first day. That was fine. But the last two sessions, climbing off the canvas, it tells me this market wants to go a lot higher.
The nice thing, Charles, right here is we finally have Europe off the front page. Europe is out of our face, and that's allowing the market to really focus on earnings, which are probably better than expected coming up, but most importantly, the economy. We're getting better than expected numbers. Nothing great, nothing phenomenal, but we're getting numbers that are better than what people expected, certainly not horrible numbers, and people are getting excited about that. It looks like we're starting to build a little bit. Europe's out of the way. We've got earnings coming up, so there is some reason for optimism right here. I like it.
You know, Keith, what would be and this is interesting, the rally baton, if there is one, what would keep it going better? Strong corporate earnings or more intervention, more Federal Reserve money printing, more schemes and gimmicks? At this point, what really would be the best medicine for the market? Just good, old-fashioned good news or more artificial pumping?
Well, the artificial pumping, another QE3, would certainly boost the stock market really hard, really fast for several months. I mean, if you're a short-term investor, you can't argue with the power of a QE3, which would really push it higher. But the problem with that is, Charles, it would show you that the economy was really slowing down and things were getting worse. So a QE3 would be horrible long-term, but better short-term. What we really want to see here is earnings start to improve better than expected. We've had a trend the last few years of earnings being reduced, expectations being reduced in between quarters, and then the quarter we've had better than expected earnings, and it's pushed the market higher. I think the same trend's going to continue. I think we're still feeling QE2 at least for another few months, which is helping economic numbers, and I think that's what we're feeling here. And as long as Europe doesn't implode on us anytime soon and it's off the front page, things are going to be pretty good for a little while, at least until QE2 wears off and the economy slows down, and then you got to kind of be careful there.
You know, here's the thing, though, Keith, with earnings. I've watched great earnings for the last 10 years, and I've also seen a flat market for the last 10 years. So are you saying that maybe we'll come to the point when earnings, believe it or not, earnings actually matter?
Well, earnings always matter, but what we're getting to is we're in a bear market. You have rallies in a bull market. What we're getting is bear market valuations. Typically in a bull market valuation, you'll have PEs of 15, 16 or higher. Bear market valuations, you get 7 to 9. I think the market is adjusting to a bear market valuation and is going to gradually come down to a 7 or 9 or 10 valuation PE, and that's what the market's up against. We're just in the middle of this bear market, probably another 5, 6, 7 years before we're out of it.
Right.
Doesn't mean there aren't places to invest. There's plenty of places to make money in this market, but you got to understand the valuations come down in a bear market, and that's what we're seeing for this.
No, Keith, it's interesting because your tone is positive, but we've got the 3 stock picks that you like, and one thing they all have in common, they've got these amazing dividends. Terra Nitrogen, 9.2%. Brightburn Energies, 9.10%. Compass Diversified Holdings, 11.6%. These are amazing. I mean, are you still going to play this market close to the vest, look for dividends before you start to spread out, maybe look for growth stocks and appreciation in stock price?
You hit it right in the button, Charles. I think if you're in this market and not collecting dividends, not collecting interest on corporate bonds, high dividend paying stocks, preferreds, you're gambling. I think the risk is too high. The risk of a downside move is much greater than upside potential. I think people are gambling. I think really investors want to focus on invest for need, not for greed. Yields of 8, 9, 10% are available in corporate bonds, MLPs, preferreds. That's 80, 90, 100% of the historical return of the stock market. That's basically equity returns without the equity risk. That's really where investors want to focus. Gambling in this market, gambling with your nest egg, you know, if you're close to retirement, right, you don't want to do that with your family's nest egg. You really, if you can pick up great yields and most of the market return, why take a chance?
I'll tell you what, 9, 9, and 11%, those are great yields. Thanks a lot, Keith Springer, Springer Financial Advisors. We appreciate it,
Thank you, Charles.
as usual.